I'm Aoifinn Devitt, and welcome to this Moneta moment, where we are going to speak about what recent high levels of inflation, where inflation has recently reached multi-decade highs, should mean for you and your portfolio. In 2021, we released a video where we spoke about rising levels of inflation and what that might mean for your portfolio. We spoke about the Fed referring to this still as transitory. As we can see from this chart, inflation levels have steadily risen over the past few months and have recently pushed north of 8%, rising to 40-year highs. As we can see from the following slide, inflation is now broad-based, and different components such as food, energy, shelter, and new and used vehicles are now comprising roughly equal components of the new higher inflation level. This is significant because not only has this been driven by the pandemic supply chain shortages, but it has also been driven by the excess money supply that has been created by central bank action. What is also notable this time is that inflation trends have been very much globally based. If we look at the next slide, we can see that inflation has not only been high in the US, but also in the Eurozone, as well as across other regions such as China. It has been much more subdued in Asia, in particular in Japan. This might suggest that a significant component of inflation in the US and the Eurozone is being created by excess consumer spending and less saving than might be seen in an area such as Japan. So what have we learned from this Moneta moment? What do these new higher levels of inflation mean for your portfolio? Just as we relayed in the last Moneta moment relating to inflation, a reminder of what can protect against inflation in a portfolio: real estate, real assets, tangible assets, especially when linked to commodities prices. In the long term, equities will provide that protection, but maybe not in the short term when there are short-term shocks. Bond ladders can also help with inflation, as when bonds mature, they are reinvested with new inflation assumptions built into current yields. Currently, TIPS pricing is at a level that does not generate a very interesting real rate of return. The real rate of return has been reducing, which indicates that inflation expectations have been rising faster than real rates of return. Overall, it's important to stay well balanced and diversified across a portfolio. Whereas any portfolio may react negatively to sharp inflation shocks, a truly durable portfolio should participate in gently rising inflation. I'm Aoifinn Devitt, and thank you for joining me for this Moneta moment.